Good evening, students. This is Professor Alexander Buchholz, and today's chapter is Audit Responsibilities and Objectives. Several different objectives for this particular chapter. Number one, explain the objective of conducting an audit of financial statements and an audit of internal controls. Distinguish management's responsibility for the financial statements from the auditor's responsibility for verifying those statements. Explain the auditor's responsibility for discovering material misstatements due to fraud or error. Describe the need to maintain professional skepticism when conducting an audit. Describe the key elements of an effective professional judgment process. Identify the benefits of a cycle approach to segmenting the audit. Describe why the auditor obtains assurance by auditing transactions and ending balances, including presentation and disclosure. Distinguish among the management assertions about financial information. Link transaction-related audit objectives to management assertions for classes of transactions. Link balance-related and presentation and disclosure-related audit objectives to management assertions. And explain the relationship between audit objectives and the accumulation of audit evidence. The first objective. So let's make sure, ladies and gentlemen, we understand what the objective is of conducting an audit. The preface to the AICPA states that the purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects, in accordance with the applicable financial accounting framework. An auditor's opinion enhances the degree of confidence that intended users can place in the financial statements. So the primary focus is on issuing an opinion on the financial statements themselves. We typically divide it into several different steps. The first step is to understand objectives and responsibilities for the audit. The second, to divide the financial statements into cycles. Third, know management assertions about financial statements. Know general audit objectives for classes of transactions, accounts, and disclosures. Know specific audit objectives for classes of transactions, accounts, and disclosures. The second objective, distinguishing management's responsibility for the financial statements from the auditor's responsibility. Management responsibilities. It is important that everybody on this lecture know that the financial statements belong to management. A lot of times, people have a misconception that the auditors are the owners of the financials. We are not. The only thing that belongs to us from Chapter 3 are the audit reports. That's it. Nothing else belongs to us. So management is responsible for financials and internal controls. Those companies that are publicly traded increase management's responsibility for the financial statements. The CEO and CFO must certify quarterly and annual financial statements submitted to the SEC. And this statement that we see in Figure 6.2 is very clear cut. This is an actual management responsibility for financial information where the CEO and CFO actually give a certification on internal controls to the auditors, as well as, of course, to the board of directors. Our responsibility is in the opinion of the financial only. The third objective is the auditor's responsibility for discovering material misstatements due to error or fraud. So our responsibilities are defined that we're obtaining, please note, reasonable, not positive assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are presented fairly in all material respects in accordance with an applicable financial reporting framework, and report on the financial statements and communicate as required by auditing standards in accordance with the auditor's findings. So our responsibility to detect fraud by itself, ladies and gentlemen, is limited. The objective of an audit is not to find fraud. That's not our objective. Our objective is to plan the audit. We believe fraud may be present. We will be looking active for it. But again, the audit itself is not going to tell you if you have fraud. Error versus fraud. An error is unintentional. So if a client makes a mistake, books something the wrong way, and there's no intent, that's an error. Fraud, on the other hand, is intentional. There's an intent to deceive. For fraud, there is a distinction between misappropriation of assets, usually committed by employees, and fraudulent financial reporting, usually committed by management. So again, two different things. Fraud could be misappropriation of assets, where somebody is stealing physical assets, cash, stealing the equipment. Fraudulent financial reporting, where management is booking something which they know is wrong in an attempt to deceive the users. We have a responsibility for detecting material errors. And we spend a great deal of time planning and performing audits to detect those unintentional errors made by management and employees. What are the auditor's responsibilities for detecting material fraud? Well, the standards make no distinction between the auditor's responsibilities for detecting error versus fraud, although, again, the primary objective of an audit is not to find fraud. The standards recognize that when you are doing an audit, first of all, fraud is difficult to detect. Why? Because people who are committing the fraud are very smart, very intelligent, well thought out, and they're attempting to conceal the fraud. Fraudulent financial reporting versus misappropriation of assets. Both are harmful to financial statement users. And as we said, the two types are misappropriation of assets and fraudulent financial reporting. Our responsibility for discovering illegal acts. First is the direct effect. The responsibility is the same as for errors and fraud. We do an audit in which we discover management is paying below minimum wage. This is illegal and has a very dire effect on financials because our payroll expense is understated, and our potential liabilities for withholdings could be understated as well, thereby grossly overstating our profit. As an auditor, we would have a same responsibility to detect these errors. An indirect effect would be no assurance. Indirect, maybe somebody has insider trading, we don't know about it per se. The standards say we really don't have responsibility because an indirect effect may not have a material impact on the financial. When noncompliance is identified or suspected, the auditor should obtain an understanding. Very clearly, folks, you need to make sure you understand what you have received and what you have achieved before you discuss the matter with one level above management. Meaning, if it's the accounts payable person that you believe is stealing, go to the CFO. If it's the CFO, go to the CEO. If it's the CEO, go to the board. The auditor should obtain sufficient evidence regarding material amounts that are directly affected by laws and regulations. Laws, such as those relating to taxes and pensions, usually have a direct effect on the amounts or even disclosures in the financial. Therefore, require more of the auditor's attention. Reporting identified or suspected noncompliance. Unless the matter is inconsequential, the auditor should communicate with those charged with governance of matters of noncompliance. Objective 6.4. Describe the need to maintain professional skepticism when conducting an audit. Professional skepticism basically involves questioning and assessing audit evidence. The elements of professional skepticism in every aspect of an audit is very hard to sometimes maintain because as we go throughout our audits, we do develop relationships with our customers, which we hope will cultivate into better relationships, more learning on our part, and really a trust. But we still need to be skeptical. We have to question, trust but verify. We need to have a suspension of judgment. Be objective. Withhold judgment until appropriate evidence is obtained. Search for knowledge. A desire to investigate beyond the obvious with the desire to corroborate. Interpersonal understanding. Recognition that people's motivations and perceptions can lead them to provide biased or misleading information. Autonomy. The self-direction, moral independence, and conviction to decide for oneself rather than accepting the claims of others. Self-esteem. Self-confidence to resist persuasion and to challenge assumptions or conclusions. Again, as auditors, we must be skeptical of our clients. Objective 6.5. Describe the key elements of an effective professional judgment process. Professional judgment is part of skepticism. The elements of the process are to identify and define the issue, gather the facts and information, and identify the relevant literature. Perform the analysis and identify potential alternatives. Make the decision. Review and complete the documentation and rationale for the conclusion. Some potential tendencies, traps, and biases to keep in the back of your mind. So, again, confirmation. The tendency to put more weight on information that is consistent with initial beliefs or preferences. The strategy that we should avoid or mitigate tendency, make the opposing case and consider alternative explanations. Consider potentially disconfirming or conflicting information. Overconfidence. The tendency to overestimate one's own abilities to perform tasks or to make accurate assessments of risks or other judgments and decisions. Challenge opinions and experts. Challenge underlying assumptions. Anchoring. The tendency to make assessments by starting from an initial value and then adjusting insufficiently away from that value. Strategies to avoid: solicit input from others, consider management bias, including the potential for fraud or material misstatements. Availability. The tendency to consider information that is easily retrievable or what's easily accessible. Consider why something comes to mind. Obtain and consider objective data and consult with others. When we do an audit, the best approach is to do something called a financial statement cycle. Everything that we know from our accounting world has a cycle. And when we audit, we want to audit the cycles with the classes of transactions that go along with the account balance most related to that cycle. The sales and collection cycle, AR, collection, cash. The acquisition and the payment cycle for our expenses, payroll, inventory, capital acquisition for fixed assets. So when an auditor is looking at all of these different items, they want to look at it together. It would be very silly for one person to audit the sales cycle and another the accounts receivable. It makes better economic sense to audit them together. Looking at the next objective, 6.7, describe why the auditor obtains assurance by auditing transaction and ending balances, including presentation and disclosure. The most efficient way to conduct audits is to obtain some combination of assurance for each class of transactions and for the ending balances and related accounts. Audit objectives for each class of transactions include transaction-related audit objectives, balance-related audit objectives, presentation and disclosure. So again, if we look at this next figure, let's talk about accounts receivable. Well, by looking at our famous T account, here's the beginning balance. Well, in auditing accounts receivable, we want to get to the ending balance. But to get there, we want to look at the sales, because we debit accounts receivable for sales. We credit accounts receivable for this cash receipts cycle. We credit accounts receivable for sales returns and allowances. And we also credit accounts receivable when we charge off uncollectible accounts. Distinguish among the management assertions about financial information. Management assertions. Management assertions are implied or expressed representations by management about classes of transactions and the related accounts and disclosures in the financial statements. Think of it this way. Management is making a claim. They are claiming something to us, and it is our job to identify the claim and make sure that it's reasonably stated. So for every single account on the trial balance, Management's going to be making a series of claims to us as the auditor. And assertions by management are directly related to the financial reporting framework that forms the criteria that management uses. Management assertions lead us as the auditors to our audit objectives. Therefore, auditors must have a thorough understanding of management assertions to perform a quality audit. The PCAOB, Public Company Accounting Oversight Board, describes 5 categories of management assertions: completeness or occurrence, existence or occurrence, completeness, valuation or allocation, rights and obligations, presentation and disclosure. The AICPA and IFRS describe 3 categories of assertions: assertions about classes of transactions and events, assertions about account balances and presentation, and disclosure. So, looking at the following: existence or occurrence. Assets or liabilities exist at a given date and have been recorded during the period. So again, we have an asset, $1 million. Management is making the assertion that it exists. Completeness. All the transactions have been recorded in the proper accounting period. Over here we have a couple of different ones. We have valuation or allocation, meaning, for the sake of argument, if we have an accounts receivable, it is on the books at the net realizable value. So again, if we believe we have $1 million receivable, $200,000 should be reserved, we hopefully see a net realizable value of $800,000 on the financial. Now again, we get to the AICPA and international standards. They kind of spread this out a little more to talk about accuracy, that the amounts have been recorded accurately, classification, that the transactions have been placed in the proper buckets. Meaning, if for the sake of argument we have an expense for food of $500,000, and that food expense was placed in the salaries line, that is the improper classification. Now you may say, Buckholz, it's still the same expense of $500, but generally accepted accounting principles and even IFRS say you need to show it in the right presentation, the right classification. And then cutoff. Transactions are recorded in the right period. Rights and obligations. The company holds or controls the rights to the assets and liabilities or obligations of the company at a given date. Finally, presentation and disclosure is an assertion that management makes. So if management gives you all the right accounting for a capital lease, but they do not do all the footnote disclosures, that technically is a problem. That technically is a problem. Because when they make the claim that they've done everything properly, that includes the notes as well. So some transaction-related audit objectives that we want to look at as well, as we saw in the previous slides, are occurrence, completeness, accuracy, posting and summarization, which is again just making sure it's being properly recorded and summarized. A lot of people use what's called a batch posting when they do journal entries. Batch posting meaning it goes all together in one file and then is uploaded. Classification. Transactions included in the client's journals are properly classified. Timing. Transactions are recorded on the correct dates. specific transaction-related audit objectives. The specific transaction-related objectives are tailored to the specific class of transactions being audited. The relationship among management assertions and transaction-related audit objectives. For each management assertion, there are general transaction-related audit objectives as well as specific transaction-related audit objectives. Meaning that, again, all of these assertions go along with each other. Balance-related and presentation and disclosure-related audit objectives. When we look at the general balances, balance sheet accounts, we look to make sure that, again, existence is there, completeness, accuracy, classification, cutoff, detailed tie-in. Detailed tie-in has to do with subsidiary ledgers. So if you're going to have basically a subledger, and the subledger is going to be $1 million, hopefully your controlling account also has $1 million. Realizable value and rights and obligations. Let's talk now about the audit objectives relationship and accumulating audit evidence. 4 typical phases of the audit. Number 1, plan and design an audit approach. The main objective of any audit is to accumulate enough evidence to provide an opinion. There are 2 considerations which affect how an auditor approaches the audit. Number 1, sufficient appropriate evidence must be accumulated to meet the auditor's professional responsibility. The cost of accumulating that evidence should be minimized. The audit plan should result in an effective audit at a reasonable cost. Meaning, we don't want to spend $200,000 on a $50,000 engagement. Because at that point, you can argue we're being very inefficient in how we're doing the audit. Planning and designing the audit approach, which can be all year long for some clients, involves obtaining an understanding of the environment as well as the entity, which we will see as we go through different chapters in this course. Understanding internal control and assessing control risk. Making sure that the internal controls of a certain corporation are defined sufficiently enough to detect material misstatements. And assessing the risk of material misstatement that the clients have on their financial. In the second phase, we as auditors will perform test of controls and substantive tests of transactions. Test of controls are very much as they sound, are where the auditors are testing the controls to evaluate the effectiveness. In other words, we'll look at controls, try to basically walk them through, understand them, draft some narratives, and see if the client's controls are being used, and are they so great, can we rely on these controls to basically reduce the assessment of control risk to maybe a lower rating. Whereas substantive tests, if you want to look at substantive with a dollar sign, is money. It's where the auditor is tracing, and vouching different transactions. Very effective, maybe not as efficient, maybe not as effective as if we could do an audit based on controls approach. Perform substantive analytical procedures and tests of details of balances. So we always want to look at analytical procedures to see are there plausible relationships. Typically, in the beginning and end of every audit, we are required by the standards to do an assessment, a prelim and a post, to see if there are any weird relationships. We can also use substantive analytics during the audit. So for example, if we were auditing a school and the school had 100 kids at $1 tuition rate, we would expect to hopefully see $100 sitting in the general ledger. That's a quick analytical. Other things we can see are tests of details of balances. The test of details of balances are specific procedures where we're looking at invoices, vouchering, sales receipts to actually see, is everything being recorded properly and do we have any material misstatements? Phase 4 involves completing the audit after we've gathered enough appropriate evidence and issue an audit report. After all the procedures have been completed, the auditor will reach an overall conclusion as to whether the financial statements are fairly presented. After the conclusion, the auditor must issue an audit report that will accompany the client's financial statements. And as we saw in Chapter 3 of the text, that could either be the unmodified, the qualified, the disclaimer, or the adverse. And that completes our material on Chapter 6. So again, overall, very high level, this chapter, giving you a sense of what the overall objectives and responsibilities are of an audit. Now that we know this, and we know what our responsibilities are to detect errors and fraud, and we now also have an idea of management's claims or assertions to us for all of their balance sheet and income statement items, now we're in a better position to look at some further details on auditing and how do we do it, and what kinds of evidence do we need to be comfortable that we've gathered sufficient appropriate evidence. As always, listen again to this lecture and make sure you're understanding the material prior to completing any and all assignments that have been assigned to you. Thank you, best of luck, and we'll see you online.